Hello, and welcome to another interactive session on our live webinar series, Moneyfy Mantra, where we speak with industry experts on various personal finance topics to help educate our viewers and empowering them to manage their personal finance more efficiently. First half of February was an eventful in terms of various policies where major ones were Union Budget, which was presented by our Finance Minister, and Central Bank had their MPC meeting where they further increased the policy rates by 25 bips. Which we feel, in which we are already feeling in our pockets, and the EMIs of various, loan products have gone up. With the policy changes and keeping a focused approach on growing wealth, how do we sail through the macros? So to cover the topic for today, we have Miss Usha Nair, Head Distribution for DSP Mutual Funds. Usha ma'am, very warm welcome to Moneyfy Mantra.
Thank you. Thank you, Harsh. Thank you very much. Pleasure to be here.
So to give a quick introduction about Usha, Usha has over 20 years of experience in institutional sales, distribution, business development, and learning and development. She has previously worked with asset management companies, namely Axis Mutual Fund, IDFC, Aditya Birla Sun Life, and ICICI Prudential. So now before we start, with our discussion for today, I would request all our viewers, they can use the comment box to put some of their questions, and we would try to take them up towards the end of the session. Just to give a quick introduction about our Moneyfy app. So we have a fully, functional investment app for our investors, wherein the customers can start their SIPs and invest into mutual funds within minutes. So we have given the link to our Moneyfy app on the description below, and please do check and share feedback. So Usha ma'am, starting with our first question for today, there is such an overdose of information, both pro and against the current markets. Could you help us understand what is happening, in both equity and the debt market?
Sure. Thanks, Harsh. That's a good question to start our session. First and foremost, when you say there is an overdose of information, it is also, the evolution of the way the media and all of us have started to educate, our investors, our partners, and the evolution of social media in the last many years that helps investors get a lot of information. Now, it's good you get different perspectives, your access to different sources of information is extremely helpful. But when it comes to investing, sometimes more can be a little detrimental to your decision-making process itself because it probably confuses you. It's one business or one activity that we all do where there can always be multiple points of view. And there is no right answer at any point of time. The answers could be, it's not as precise as we may want to believe it is. And for the benefit of all the audience, I would say there are many legendary investors who believe, and it is rightfully so, investing is as much a science as it is an art. Okay, there are two sides of the same coin. So having given that context, today there is a lot of information, I understand, and there are people who believe if the markets are one group of investors or market experts believe that India is an overvalued market, globally things are not looking too good. Probably there is a recessionary environment in the US, and that then affects various parts of the world. The geopolitical things that are still not fully clear. Europe has its own share of problems, so on and so forth. But there are a lot of, so this is one group of people, and any argument or data which supports that aspect could be available. Now, if you want to create that dimension of view, and I want to present that view, I can give you enough and more data points that will help you have that dimension of conversation. But if I flip the page or if I shift to a different gear and say that India GST collections are good, we are in a very stable environment, we are sort of out of the COVID regime, activities are much better, be it travel, be it shopping, be it everything else. That is, the indicators, the economic indicators, they are very robust and positive. and the import, the export, all of that. If you talk about the macroeconomic, and the companies are doing more business, all those positive sides I can bring and present another picture. So on the same screen I can put two sides of the coin, saying that this is the positive and this is the negative. Now as an investor, when I listen to this, what do I believe, or which side do I take? I would say that you don't have to take any sides, because neither of this matter to a long-term investor. There are valuation products available in the equity stocks, sectors, funds that you can invest. There are methods of investing through SIP, STP, etc., or buy in dips. So just to give a perspective, October 21. So I'm doing up maybe an 18-month to a 22-month kind of a flashback. Markets peaked in 2021 at 18,000 plus Nifty. It went down all the way to June 22 to 15,000. So that's a 3,000 point correction, which is close to 20% kind of correction. It went all the way back to 18,000 plus. So we retraced the lost ground. And then again, in the last couple of weeks, it has corrected. So markets have been in this period of October 21 to now, it's gone through two rounds of up and down movement, which whether the market is bullish, bearish, neutral, as an investor, it has given me opportunities to purchase. Within that, if you're an MF investor, you could have bought MF, you could have bought funds, you could have bought stocks, you could have bought indices. There are various aspects to buy. So overdose of information would be justifying each side of the movie that I want to see, the first half or the second half, or whether I want a tragedy or a comedy in the movie or whatever it is. But ultimately, as an investor, I have had opportunities to invest in the market. If I have done SIP, I've made money. If I've done lump sum purchase, I've still got money. If I've done stocks, there have been opportunities to make money. So that's the, how do I do? Can I say that there will be no overdose of information going forward? I think it's a too dramatic a wish list to have. We will live in an era where there is overdose of information and we will get confused. So when I'm confused, it is a process or a discipline that can help you to go through it. And that's true in any aspect of our life. Today, if you want to do a healthy life, there are multiple concepts that will come to you. You do fasting like this, you do exercise like this is good, that is good. But we do what is beneficial for us and what is doable. Same is the case with investing. Same is the case with movie review also, something as simple as that. So that is how I would suggest that as an investor, I would approach it in spite of being in this industry. This is what I personally do to my portfolio. Coming to fixed income, so markets, just to get a rational part of the conversation, Harsh, so that we can end this question and move to the second one. Is Indian market a little expensive? Definitely it was expensive. It has corrected. Is it still cheap? No, it is not cheap. It is moderately or fairly priced. You are getting opportunities in 1 or 2 times during a month or intra week to participate in a small manner, in a meaningful manner, depending on how you want to allocate. Asking Tata Capital your asset allocation, asking the RM in Tata Capital, how do you want to structure your portfolio? I'm sure they'll give you the advice. But markets are slightly overvalued or moderately valued, I would say. Not overvalued, maybe a slightly wrong statement. It had corrected. So from an overvaluation zone, it came to a moderate valuation, but it's still not in that cheap spectrum that you would like it to be in, which is why some sort of caution is good. But when the markets correct 2%, 3%, 5%, please put in money and keep some cash ready to take advantage of that. I'm sure there will be more questions on fixed income, but a quick one-liner on fixed income, it's probably the best time to look at fixed income. So with that, I would, probably close my answer for that question.
Correct. And rightly said. So, market indicators like, Nifty, price to earning, price to book, are there to their, averages. It's not at the peak, neither it is at their bottom.
That is right.
What percentage of investor portfolio can, one make fresh, allocation to equity? So,
Yeah.
Should I incrementally put 80% of my investments into equity or fixed income?
So, Harsh, I would say that, each investor should go through his advisor and check on the asset allocation that is applicable to him. But I would say that a slight increase in your equity allocation would be a good thing. So if I'm a 50% equity investor, can I go up to 60%? If I'm a 70%, can I go up to 80%? If I'm a 20%, can I go up to 30%? I think that's a good way to consider it, because maybe I was 20 or 80 when markets were a little overvalued. Now markets have corrected reasonably from those levels. Hence, slightly increasing my equity allocation is meaningful to do. And if you need to further increase that, probably a systematic way, STP or an SIP route is reasonably good to go. Incremental money to bring a balance to the portfolio, you want to consider fixed income. Today, a fixed income product offers you anything upwards of 7.5% of return. Bank FDs are offering, but they are not tax efficient. Through the mutual fund, there are enough and more options that are very, very tax efficient and will give you reasonably good returns, which is not seen for a while in the last couple of years. So you're coming back to a range of interest rates in India today, which was probably seen almost 5 years back. So you're revisiting that scenario. And debt markets, fixed income markets behave in a cycle of 5 years. Every 5 years, for whatever reason, you see some peak in rates, and that's when it's good to pile, if I may use that word, fixed income in your portfolios. And then you enjoy the benefits of that investment for the next 3 to 4 years. Then you'll see a lull, and then again it comes back. So you are in that period where the storm has sort of subsided, and it's a good entry point, a clear path for you to drive your vehicle. So hence, a slight change in allocation to fixed income from the normal allocation that you do would also do portfolios quite good in this juncture.
Okay, so ma'am, you mentioned briefly on SIP route. So should one go, if I say have a lump sum investment amount available, should I still go for SIP or get in lump sums, because the markets have corrected nearly 12 or 1300 points from its peak. Roughly it is down 6%.
That's right.
So should I consider as an investor continue to go through the SIP or an STP mode, or getting some lump sums will also help?
Yeah, definitely some lump sums can be done, because a 6 to 7% correction is not a small correction that you would want to ignore, because like I said, in the previous correction you got about 15 to 18%, so almost 40% of that you have already got again now. So maybe you will get another 6% correction. Who knows? We don't know that. But definitely 6 to 7% is a correction that you would want to put some money in the lump sum format, and then you can do your STPs or SIPs. I'm not advocating that you should only do through SIPs. Of course, when there are 5, 7, 10% kind of corrections in the market, some sort of an investment into the market, increasing your equity allocation, these are all very well time-tested strategies, and that always helps you do very well. The reason that I'm also suggesting, Harsh, SIP is, the concept of SIP is rupee cost averaging. And we always believe in SIP. One, of course, it gives you a very long-term benefit because it's discipline with patience. But there is one circumstance when SIPs do really well is when markets are volatile, it's the power of an SIP to show much better outcome is very high. So last 1 year, if you had done an SIP in a globally oriented technology funds or an Indian IT fund, your SIP returns are definitely much higher than lump sum, because the markets corrected in these sectors by 30, 35%. And if I can buy something at 65 rupees instead of 100 rupees, the number of units I gather is very high. And today, many of those stocks have retraced prices. The fund NAVs have gone up. So in a very volatile market, doing SIPs make you feel happy as an investor. It may be notional. It may not be a joy that I'm going to redeem and go away. But at least as an investor, I feel very nice when I see my portfolio that what I put has given me 12%, 13%, 14% kind of return, while the market news was very negative on those sectors. So it just gives me that joy. It's also a feeling of happiness when I see my portfolio. So to enjoy that, you need to do SIP in volatile times.
Correct. And also it gives you a good experience, so that you can stick to some of these products for your long-term investments.
Absolutely, very well.
So ma'am, tactically allocating some of my money, any particular sector, which is looking lucrative at this point in time, where someone can overweight?
Sure. So I will tell you, and you asked about the first question, which is the overdose of information. So I'll tell you one through the dose of information that we have heard, and every investor who's on the call would be aware of, and something that is less spoken and there is limited information. So I'll give you sectors and funds that you can consider in both the things. The most common spoken trend today, and which is believed will do well, is the investment theme. The infrastructure or the Indian economy led stocks because of the 5 trillion economy, the positioning that the government is doing in building, bringing back the investments into the country, private capital getting into investing, so on and so forth. So all the segments of companies which are manufacturing, defense, all of them are gathering a lot of attention and very positively. Even the recent budget, which happened on 1st of February, is giving a lot of impetus to capital creation, which means, companies will have to deploy capital, put up assets, and it will also attract global capital and so on and so forth. So there are a lot of companies which will benefit out of that. Obviously, that sector has done well in the last 15 to 18 months, and there is positive news around that sector. So that's good. Very long runway is there for that. A stable government always helps you to achieve that, and not just the government. Many companies are also today very rich in their resources to deploy and put up a plant or a capital investment. Bank balance sheets are extremely clean today from what it was 5 or 7 years back, and bank is the backbone of an economy, and hence banking will support this sector, which is the investment theme, also will do well in its own in isolation. So that's another sector or a segment that can deliver good returns for you. So these are two known things spoken about. Everybody understands this. What is the less spoken about sector, which we as a fund house is reasonably confident, is the healthcare or the pharma sector. Why do I say healthcare or pharma sector? It is one sector that has not participated in this last 18 months of Indian equity market growth story. There are reasons why it has not happened. But whenever you look at it, any sector which has not performed for a couple of years, and if there has been a broad-based market rally, 5 things have done well, and one person has not participated in that, usually that sector or segment comes back with a force in the next couple of years. Now, what is important in this is, when will it come back is definitely not a question that you cannot answer. But will it come back usually is a very affirmative or a positive answer that you can give. And all the right reasons for the sector to do well is there. It has not participated. Valuations are reasonably attractive in that sector. So if I were to summarize, investment theme, the banking sector, and the healthcare or the pharma sector are 2-3 sectors that an investor should consider, which will be available through diversified equity funds, but even through sector funds, he should be able to participate.
So ma'am, while we spoke about the sectors and the theme, should one, approach this in an active, investment way or a passive way through an ETF? Because there are a lot of ETFs which have come to give a sectoral exposure going forward.
So I love this question, Harsh, and this is a standard debate today in every conversation with investors that we have. And there are many analogies that you can, use for that. If somebody were to ask me home food or hotel food, it's nice to say home food, but it would be incorrect to say never ever hotel food, right? We all enjoy our meal maybe once a week, once in a month. If you have to travel, you have to try food outside, all of that, right? Similarly, when you talk about driving a vehicle, there are manual cars and there are automatic cars. Both have its advantage, disadvantage. Now, a true driver who really enjoys driving, who wants the control in his hands, would say a manual car is a better one because he gets the power. But someone who's a very, you're just driving so that you're taken from point A to point B, would say an automatic car would be good enough for me. But a car manufacturer will manufacture both. And as a car buyer, there would be some periods in my life I may have driven a manual, I may be driving an automatic. While I'm driving an automatic, if I have to drive a manual, I may do that. So active passive is also something like that. Why did I bring these 2-3 examples? Because it is again not black and white answer. It is not either or. I would say it is an and product. You would need to do active funds and you would need to do passive funds. Now, when you say active or passive from an investor's perspective, he should be passive permanently. That's what I would say. He need not debate whether I'm doing an active or a passive. A good investor is one who is passive. What is passive? Passive is investing and forgetting, doing the right selection of product when I have to do it, and then you forget. So I would say I am permanently a passive investor. Each investor should be a permanently passive investor. How to do your investment? The fund manager is the one who is active or passive. I don't think the investor should worry. Even if you put money in an active fund where a fund manager buys stocks today, sells it in 6 months or 9 months, and buys another stock, me as an investor should remain passive about it. I don't have to repeat his action. So all investors, all of us as personally investing our personal money should be passive investors. And that is what long term is all about. But how does the fund manager do his business? Is the car engine automatic or manual is something for the manufacturer to decide. As a driver, my objective is to drive clearly, not to make an accident, and reach my destination in a comfortable journey. So I would say that way there are good and I won't say bad is a wrong word, but advantages as and disadvantages of both types of investing. As an investor, please have both in your portfolio because there would be a healthy mix of, and you can't get some benefits of passive investing in active investing. Similarly, you will not be able to replace completely what you get in an active fund through a passive fund. So both are required, but as an investor, be permanently passive.
Sure. So, now, moving to some fixed income, related questions, so last, I think, 12 months, the RBI has continuously gone ahead and increased the policy rates, obviously, because, we've seen rise in inflation. Should I, as an investor, while, equity is also looking attractive after a recent correction, should I, put in, a lot of money into fixed income assets now, or I should still wait, because, RBI has there been any hints of no further, policy rate increase? And if there is any particular category of mutual funds, which category should, one look forward for?
So, a very valid point. And Harsh, what is more interesting is I'm sure most of our investors who are there on the call today and who will probably watch it later on also, all of us as Indian investors have a large propensity, liking, willingness to put money into fixed income products. Now, while you and I may say fixed income, a bank deposit is something that no investor would do without, right? And our job as educators of this product range is to make our investors understand how beneficial a mutual fund product in debt or fixed income is, which can be a very good replacement for your bank assets or deposits, and gives you better tax advantage, which is a huge advantage as far as Indian markets are concerned. And that's a benefit that mutual funds enjoy over a bank deposit. Now, in a bank deposit, a lot of investors would believe that there is predictability of return. I'm getting 7%, 7.5%, etc., which is correct. There are many products in the mutual fund which is constructed on similar lines, and added like a cherry on the cake or an icing on the cake, you get that tax advantage, which is humongous, because a high net worth individual or a highest tax bracket person in India pays 30% plus taxes. If I can get a tax benefit, that's a lot of post-tax return differential as far as my investment portfolio is concerned. So please do consider, talk to your advisor in Tata Capital on how can you replace some of your fixed deposits or fixed income products through the mutual fund fixed income. So I'm saying asset to asset, it's orange to orange, apple to apple, but it will have one layer of additional benefits to you through the tax advantage. Now, coming to your question, Harsh, on is it time to look at fixed income? I always like to use the small example from cricket. It's a game that all of us enjoy. When you are a cricket batsman, a bowler can bowl a yorker for you or a full toss to you. Now, if I'm a batsman playing cricket, a yorker ball is a very difficult ball for me to play. And unless I'm Dhoni, I would probably, not try to play that ball because it can be a big loss of wicket for me. And if a full toss is given to me, normally as an investor, I would like to, as a batsman, I would like to hit it for 4 runs or 6 runs kind of a thing. And we all know at least some of us in that age bracket would know the famous Chetan Sharma full toss to Javed Miandad many years back. And even recently there were conversations around a similar episode and all of that. So that's for a different day, different time. In fixed income market, when the interest rates are in a range which is say 5%, 6%, etc., we call them the Yorker zone. Usually fixed income investments become very difficult because when you walk into a bank, you get 5 to 5.5% fixed FD rate. When the mutual funds are bringing products in front of you, the general interest income that you generate out of it is in that 5 to 5.5%, usually in that rate, which is not very appealing to you as a fixed income investor. And those are usually the times when there is a lot of advantage in investing in other asset classes like equity. That's also the time where you can acquire assets at lower rate because your bank EMIs, and you referred to EMI in the opening remarks, Harsh, that they are definitely on the lower end and it helps you to do some other asset class investing, etc. But there are also these full toss zones where your interest rate in the economy is at 7%, 7.5%, 8%. And that is when you probably get banks today, they talk about high interest rate. But that is actually the time where an investment into a fixed income mutual fund product makes the best sense. Coming into a short-term fund, coming into the roll-down funds or target maturity funds, the standard traditional mutual fund products, it offers you extremely good entry point. Like markets, when they are at 15,000 Nifty or 12,000 Nifty, how excited we would get. On the same manner, you should get excited when your fixed income rates in the market are at 7%, 7.5%, 8%. It's a very good green signal for a fixed income investor. And we are in that scenario. That's why I'm saying that's a full toss zone. And in a full toss zone, you don't try not to score runs. And that's what you should do. So fixed income is definitely going to be there for a while. Even if RBI hikes interest rate once more, there would be a period of pause and then there has to be a reversal. But it's not a short-term journey. It may be a 3 to 3.5 year journey. But definitely I would put more money today in fixed income than I would put otherwise.
All right. So that, there is a concept, of a BER ratio, BEER, ratio. So if you could help understand what does that means, and its relevance to investing.
Sure. So, just like I spoke about fixed income or debt market and equity. So let's just spend a minute to understand what do you look for when you invest in fixed income and in equity. When I invest in fixed income, I have something called an interest income, which if I'm doing a bank deposit, I call it interest. If I'm buying a bond or a debenture, I call it coupon or interest. I mean, we still say, what is interest I get in a corporate deposit, an HDFC limited deposit or something like that. That's what we speak about. So there is an interest income. Now you call that in a different language, you say the earnings yield. What do I make on my 100 rupees invested from a fixed income product? It could be bank, it could be company deposit, it could be a Government of India security. What is it? So for simplicity, the income that you get from that. Similarly, on an equity stock, there is something called an earnings yield that you make on that as well. Now, what this ratio does is, it is basically meant to help an investor decide what is more attractive. It is in some way that when I go to buy a mobile phone, I do a comparison of features. When I have to buy any product, anything, I will do comparison. If I have to buy a car, now I may know my budget, but whether it should be a Maruti or a Hyundai or a if I'm buying a higher end car, then I'll compare 2, 3, a Skoda or some other car, which is a higher end car. You'll do a comparison. Now, when it comes to investing as an investor, Harshmi, all of us on the call, I ask this question, should I buy in equity now, or should I buy fixed income, or should I buy this stock or this company, this fund or that fund? So there is a little bit of comparison in any decision that we do. When there is buying, there is comparison. And how do I compare the two asset classes that are available for me so that my asset allocation is done properly? So this ratio is something that tracks the earnings yield of the bond to the earnings yield on the equity. Now, how it is calculated, I will not get into it, right? The lower it is, it makes it more attractive for an equity investment. So if the ratio is below 1, say closer to 0.6, 0.7, 0.5, etc., it's attractive. It is telling me, suppose I say the ratio is 0.5 or 0.6 and the ratio is 1.2. When I hear it is 0.5 or 0.6, it should be that please go and buy more of equities. But when it is 1.2 or 1.3, it tells me that be cautious on equities, go more investing into fixed income because the valuations are higher in the equity market. So for simplicity, just ask the ratio if it's above 1, above 1.2, 1.3, slow on equity, more on fixed income, lower the ratio, attractive to equity, put more money into equity. So March 2020, the ratio was 0.7, 0.6. January 2008, the ratio was low. March 2013, when India went through a lot of crisis, the ratio was low. And all those times, if you had invested in equity, you have made fairly good returns. Today, it is slightly above, and it is connecting to everything that we said. Valuations are not cheap. It's not extremely expensive. So a moderate allocation with a bias to fixed income is good to be in. That's what the ratio is.
Sure. So, we covered, the Indian equity markets, we covered fixed income, and, we'll slightly cover the international equities as well.
Yes.
So India as a market was, trading at a premium compared to its peers, some months back, largely the emerging market. Could you please, elaborate on this and, where do we stand today in terms of valuation?
Sure. So that's a fairly interesting question also, Harsh, because we went through a phase. So if you take in, see, we are today in March, almost nearing March 23. And around March 2020 is when COVID hit us and we went into the first lockdown phase. So it's probably the third anniversary of that is coming up. Now, when we talk about that period, the world didn't know what hit us. Everybody went into it with panic and a lot of things happened. Markets significantly corrected when COVID hit us. And then how did economies come out of that COVID phase? The vaccine development, what we did as a country, economy, all of that impacted the way each economy performed, the perception about the economy by the external world, and the equity market behavior largely got led into that. In that phase, India as an economy, the vaccine methodology we had, the way we handled COVID, this is widely accepted and appreciated by the world. Many other countries, including developed countries, went through a lot of pain points, which we didn't go through. And we are a large population. We are the second most populated country in the world. And in spite of that, with the kind of economic scenario that we have, we could manage it quite well. And that led to a lot of belief system in our economy that led to a lot of money flow into us. There was another reason, the US interest rates was reduced significantly, which freed up a lot of capital from that economy. And that also chased India as an emerging market. So we were among the peer set, all these COVID-led factors and economic factors were favorable. Having said that, there was money available freely to invest. So when that availability was there for the foreign investor, which country did he choose? He actually chose India. And that led to you getting a lot of money, which led to stock prices going up, valuations going up. And there was sort of a premium of the Indian market that happened. You also have to see it in the other context that many of the other emerging markets are also commodity-led markets. So when commodities do well, those markets do well. When commodities don't do well, Russia, Brazil, all of these are commodity markets. And India is a service economy. And that is where, we also got a lot of money that happened to come to India, etc. But there is some stage that whatever goes up, you say, has to come down. And somewhere in October 21, after all this money flow, market valuations in India was at a premium. There was a conversation in the US that interest rates are rising and they will increase interest rates, which means the cheap money is reducing. money will retrace back to the home country, which is why Indian stocks were sold. The FIIs took the money out, and that impacted the Indian market. When that happened, our valuations generally corrected. So this was how the flow of the money happened. In parallel to all of this, the global technology companies started seeing a lot of crisis in the last 1 year, especially 2022. 2021 was very good for them, but when interest rates in the US started increasing, the global technology, be it Facebook, be it Microsoft, be it Apple, all those companies significantly corrected in prices, and the US technology segment, which was probably the darling of the stock market for almost 8 to 9 years or 10 years, became sort of the most criticized and sold stocks in the world. That led to significant price correction. But that is also the point that it is good to add these stocks. Will they give you phenomenal return in the last, next 2 years? It may not. But can they give you good returns over the next 5 years, 7 years? If you systematically invest, yes, they can. Because not for any other reason, these companies are some of the world's best companies. Every second that we are using them, we are consuming them. We cannot do a world without digital technology, smartphones, and everything that goes into it is adding a dollar or a rupee to these companies' profits. And hence, these businesses are there forever. The dimensions may change, their business models may change, but we are in an era where a company which is technology led will do well. Not all of them, the good ones, the cash rich ones, the smart ones, which is why when you go through a mutual fund route, investing when they go through their pain point is one of the best things to do. And we have seen those examples, Infosys stocks. If you take these small examples, how some of those good companies have also gone through pain point. And if you have invested in those companies, how your returns have changed significantly. Same is the case with global investing, especially the technology sector. Good companies available at discounted prices. That's the time to do that. The best way to do that is through SIPs, which is also available through you. And you should consider them, is what I would say from a long-term investing perspective.
Sure. So I think, Usha, with this, we have come towards the end of the session for today. It was extremely insightful for our viewers. Thank you for your time to conduct this session. So for our viewers, thank you all for attending this session. Again, just reiterating the point, you can download our Moneyfy app, by clicking on the link given in the description below, and start investing into SIPs, whether you want to invest in the domestic funds, international funds, active, passive, everything is available. To get regular updates on our offerings and for more such insightful videos, please follow us on Facebook and subscribe, to our YouTube channel. Thanks, Usha. Thanks everyone for your time.
Thank you, Harsh, and thanks to entire Moneyfy and Tata Capital team.
Thank you.